You've always said never sell your Bitcoin. You floated the idea to at least let them know that it's there to be sold in theory. How much unencumbered Bitcoin do you have?
It's all unencumbered. Right. It's 818,000 Bitcoin. If we were to say we're never going to take advantage of that liquidity, then we're impairing the asset which 98% of the company is built on. We might sell 20 basis points of Bitcoin in a month. We'd probably buy 5x or 10x that much in the same month. So Stretch represents a bank account that pays you 11.5%. We found a consistent way to buy tens of billions of dollars of Bitcoin with credit market capital. I say I'm buying the top forever. I'm happy to buy at 60,000. I'm happy to buy at 80,000. I'm happy to buy at 120. I will be happy to buy at 200,000, 500,000, a million, 2 million, 4 million, 8 million, 16 million.
Wait. Did Michael Saylor just say he'd sell Bitcoin? Before you freak out, watch what he says next. This might be the most bullish thing he's ever said. If you like this content, subscribe for daily uploads. Stay with me, because what he reveals at the end about why they might sell will completely change how you think about this.
What we discovered is you need that intermediate step, and the intermediate step is digital credit. So the idea behind Stretch or digital credit is you're converting a capital gain into a dividend, a credit dividend. So if I expect 30% returns on Bitcoin capital, I can just strip the first 11% and pay it as a credit dividend. So the way we created Stretch is we created a preferred stock that's a monthly variable rate preferred, and we pay like 11.5% right now. And the way we fund that dividend is through investing in Bitcoin and then capturing a portion of the Bitcoin capital gain, monetizing it. And so the first step to creating digital money and yield coins and putting yield into the DeFi ecosystem, which powers it, it's like electricity jacked into DeFi. The first step is create digital credit. And we were uniquely able to do it because we inadvertently built a $50 billion equity stack when we built Strategy. And so we have about an $85 billion enterprise value now. We've got about $58 billion of equity. And for every dollar of equity, you can maybe sell 20 cents of credit. You want to be 5x over collateralized. So we took our Bitcoin and everybody said, well, what are you going to do with the Bitcoin? How do you generate yield on the Bitcoin? And we thought, well, we're going to actually sell the credit to generate the yield. So we discovered Stretch, we created it, it exploded. It started growing 300% to 400% a year. In the month of March, we sold about $1.5 billion of it. And in the month of April, we sold $3.2 billion of it. So, multiply 3.2 times 12, and it's a horrendous, incredible, terrific run rate. So that was the first step, taking digital capital, making it digital credit. And people think, well, you're crazy to pay 11.5% dividend yield. But the point is, it's a perpetual swap. We're basically swapping you SOFR plus a credit spread forever, and we're getting back Bitcoin return forever. Stretch has hit a Sharpe ratio of 2.5. Digital credit is 2.5. And we've got a proposal in front of our shareholders to cut the dividend, to double the dividend frequency. And if we double the dividend frequency, we think that the volatility is going to fall further and the Sharpe ratio is going to move north again. So let me put that in perspective. A 2.5 Sharpe ratio is higher by a factor of 5 than every credit instrument in the world, maybe a factor of 10. It's higher than every equity. Like, the highest Mag 7 Sharpe ratio is NVIDIA, it's 1.7. Every other equity is 1 or less. It's higher than every asset class. The Sharpe ratio of the S&P or Bitcoin are 0.8, 0.9. The Sharpe ratio of gold, 0.5. It's higher than every hedge fund strategy. Every hedge fund where you're playing 2 and 20 and you've got lockups, if they could get a Sharpe ratio of 2 or 2.2, they could raise infinite money. Okay? We've created an instrument with a Sharpe ratio 2.5, 3 or so, and there's no fee. It's liquid. Anybody can grab it. And that means that you put that in a token, you tokenize it. You're saying to yourself, what's the instrument that I would like to plug into 10x leverage? And the answer is you want something with an extremely high Sharpe ratio, because when you 10x 2 vol, that's only 20 vol. That's just the S&P.
Right.
you know, and so we've created, I think, with digital credit, something which is really good for Bitcoin. We found a consistent bid, a way to buy billions, tens of billions of dollars of Bitcoin with credit market capital. And we've also created something which is really good for DeFi and really good for crypto, because now we can power the entire DeFi and the entire crypto complex with something which has got 3x the energy of a T-bill.
Right.
You could boil it down to capital gains, fund, credit, dividends. If you think about the theory of asset-backed credit, if you think that the capital investment is going to appreciate at 10% a year, you can pay a dividend of 5%. If you think the capital investment is going to appreciate 20% a year, you can pay a dividend of 10%. If you think that real estate's going up 7% a year, you can pay a dividend of 3 or 4 or 5. We think Bitcoin's going up 30% a year. We have no problem paying a dividend of 11.
But you don't need it to.
We don't need it to. We're so over collateralized that the way it works out is, if it goes up 30%, you know, when we sell $1 billion of STRC, if Bitcoin goes up, you know, 11%, we'd make $1 billion in net income, that our Bitcoin gain. If it goes up 22%, we'd make double that. We'd make $2 billion, $1 billion up front and $1 billion over time. If it went up 30%, we'd make $1 billion up front and $2 billion on the back end. It's screamingly profitable for the equity investors. But on the other hand, if all Bitcoin has to do is go up our break-even level, which is 2.3%, for us to pay the dividends forever. So we
and that's
really,
on average. That doesn't mean you can't have a down year.
Yeah, on average, over forever,
Right.
we need 2.3%. And if we don't get that, if we get 0%, we have about 50 years, 40 to 50 years to figure it out. Only a small percentage of people, you know, have the conviction to do that. The people buying Stretch are retirees. You know, 65-year-old guy wants to live off of his retirement income. If, you know, they're conservative investors. They're corporate treasurers. Like, I need the money back in 6 months to pay taxes. I need the money in a year to pay my kids' tuition. I want to get paid double or triple or quadruple a money market, but I don't want to risk my principal. So if you think about people that need they need principal protection, and they want to compound their wealth in a low risk, low anxiety way. They want to preserve their wealth while they compound it faster than inflation. That's a lot of people. And so, you know, Stretch represents a bank account that pays you 11.5%. And if you walk down the street and you say to people, do you want to buy a highly volatile equity? Do you want to buy a highly volatile crypto asset? Or do you want a bank account that pays you 11% that you don't have to pay tax on for the next decade? You know, you do the poll, it's not complicated. There's a lot of people that will say no to the first two, and they'll say yes to the third. But here's one more point. Even the people that would say yes to the first or the second, like if you're willing to bet half of your what net worth on Bitcoin or half of your net worth on Nvidia, you still have money that you need to pay the mortgage, taxes, your kids' tuition, or you have working capital in your corporation. And that working capital is what I'll call short duration capital. You know, you need it back in the next 3 years, and you can't afford for it to be worth 30% less on a drawdown.
Obviously, as you said before, you've always said never sell your Bitcoin. You floated the idea in your earnings call, said, you know, inoculate the market to it, which I think is just an evolution, in my opinion, right? Because you have to at least let them know that it's there to be sold in theory. How much unencumbered Bitcoin do you have?
It's all
strategy?
unencumbered.
Right.
It's 818,000 Bitcoin. The real key there, Scott, is we own about $65 billion of Bitcoin. If the market thought we would never sell it, the credit rating agencies would say, well, then I guess it's not an asset. And there's $20 to $100 billion liquidity in the Bitcoin market that is not correlated to our equity or to our credit. If we were to say we're never going to take advantage of that liquidity and we're never going to use that asset, then we're impairing the asset which 98% of the company is built on. it's pretty important for us to send the signal that if we need to, we can. Now, that's not the same as decrease our Bitcoin stack. The truth is, we might sell 20 basis points of Bitcoin, like 0.2% of Bitcoin in a month. We'd probably buy 5x or 10x that much in the same month. So people are getting caught up on that. But if you sell $100 million of Bitcoin in the same month that you buy $1 billion or $2 billion of Bitcoin, we're still net buyers of Bitcoin. We're still net holders of Bitcoin. But the benefit to being able to fund with Bitcoin is we have the option to never sell a share of stock again, and that really rips the faces off of the shorts. That's good, right? And then we also have the option to capture the tax credit, because we have billions of dollars of tax credits that if we were to simply sell the high basis Bitcoin, we would capture the tax benefit and we could fund the dividend. And then with STRC, we're selling so much STRC that we'll buy back 10 Bitcoin for every 1 Bitcoin we sell. And if you can do that, I would recommend you do it too. It's not a bad business.
I mean, it's just mechanics. It's
Yeah.
not selling Bitcoin.
It's not reducing your Bitcoin.
Right.
Yeah.
Makes perfect sense.
The money will move, or the capital will move when the investors trust the bank. And so this is really an exercise in education and execution and trust building, and it starts slow and then it goes faster and then all of a sudden it explodes.
Well, I think we've seen
virally.
that. We got 29 seconds left. Is there ever enough Bitcoin? Do you ever stop?
No, I think our view is our job is to power up the network. So I say I'm buying the top forever. I'm happy to buy at 60,000. I'm happy to buy at 80,000. I'm happy to buy at 120. I will be happy to buy at 200,000, 500,000, 1 million, 2 million, 4 million, 8 million, 16 million. And people will make fun of me for doing it. But, Bitcoin would be trading at 16 million a coin and they can make fun of me all they want. For us, the key is for us to just be steady. The rest of the market will set the price. We will, buy 10 Bitcoin, might sell 1 Bitcoin, buy 10 more, sell 1 more, grind up. And I think it's just good for everybody in the ecosystem. Everybody's winning.
Thank you, Michael. Appreciate your time as always.
So here's the bottom line. Saylor isn't selling Bitcoin. He's playing 4D chess, sell a sliver, use it to signal to credit markets, then buy back 10x with the proceeds. Meanwhile, he's building a financial instrument that beats every asset class on Sharpe ratio. Love him or hate him, you have to respect the conviction. If this video made you think differently about strategy or STRC, hit like and subscribe. I'm going to keep breaking down these Saylor interviews because there's always more buried in them than the headlines suggest. And drop in the comments. Do you think Bitcoin hits 1 million a coin in our lifetime?